the alligator principle, which is cut your losses quickly or risk being eaten whole. Can you explain what this alligator principle means in practice, and
Well,
how does it apply to strategy?
well, it's easy to preach and easy to tell. In practice, not easy to do. Because what's the idea? This may be a little bit sinister, but and I hope it never happens, but when you fall in the water and you're attacked by an alligator, the strategy of the alligator will be that they will take you in some sort of a grip somehow, and you cannot get loose. And the more that you struggle, for example, it takes you by the arm, and it's very sinister, I'm sorry, but it takes you by the arm or the leg. Well, you, in a way, the more you try to get your leg free, it will take your arm as well, and eventually it will swallow you whole. So the only thing you can do with an alligator when it has your leg, sacrifice the leg and get away with what you have. So that's a bit what you have with the alligator principle. And if you let's go to something that's more fun than being eaten by an alligator, you go to the stock market and you have a position, you lose 10 or 15%. The investment thesis that you put forward does not apply anymore. Things go absolutely wrong on the fundamental side. You see technically the picture deteriorating while you look at it. And you can say, well, it's 15%, but I'm not going to take that 15% loss. I wait a bit. And then it becomes 30 and 40 and at the end of the day, you've lost everything that you've put into it. So that's the alligator principle. Cut your losses short. And in investing, if you have two pieces of advice, or it's actually one, let your profits run and cut your losses short. And that's what we preach each and every day to our clients, until you have to do that yourself. You have two equities, two different stocks. One, you have a profit of 30%. One, you lose 20%. And you want to go to the coast. You want to have a nice barbecue. You have to drink with friends. And what you do is, I take the 30% profit because that feels so fantastically good. And you know what? I let the 20% loss. I let the position run because it will be all right. And then you come back after 2 weeks, and the thing you sold at the 30% up is up 50%, but you sold it. And the thing that was down 20% is also down 50%, but you still hold it. So that everybody knows that if there is one golden rule in investing, and it's not only equities, there's commodities, it's bonds, it's everything, let the profits run and cut the losses short. And it's extremely easy to write about it, extremely easy to explain that to everybody, until you have to do that yourself. And then you need discipline, and then you have to have had enough Olivettis in your portfolio that became absolutely worthless to say, maybe this time I will do it differently. But still, after all these years, it's still very difficult.
Wow, I love that one. Gosh, I have so many of these analogies in my notes that you've said over the years. I mean, and I have so many of them, but we're getting close to the end of the conversation. So I'm gonna choose very wisely one last one, and then we'll wrap it up. But another one that I wanted to ask you about is this least wrong approach. You've said that in investing, it's not about being right all the time. It's about being least wrong, especially over time. So what does a least wrong mindset look like in practice?
Well, there is a book, and once again, there's always a book. Best Loser Wins, I think the title is. It's about a trader as well, written by a trader, I believe, and I'm sorry, I'm not absolutely correct, but I love the book and I have it. In a way, we have to be humble, because we cannot predict the world perfectly. We don't have a crystal ball. Anybody who says he has a crystal ball basically is probably telling a lie, or probably making things look better than they actually are. But you can be a little bit better than the consensus. Where the money is made in markets is you have a consensus. We also know that the consensus shifts all the time, and the consensus is most of the time wrong. So if you can get this consensus a little bit better, looking through your three windows to the world, and then say, maybe everybody is bullish on this, but I don't like the chart, or I don't like the fundamentals, or I just talk to a very intelligent guy and then he says something totally different. And then you can tweak your positioning a little bit and then you can make some money. But it's very hard to do. But I think that's the main thing. It's the future is by definition unknowledgeable. You will not know it, but you can try. And the fact that we cannot never know it perfectly should probably not prevent us of trying at least. And if you're a
Yeah.
little bit better than the consensus, you can make money. And then with the golden rule we talked about in a second ago, let the profits run and cut your losses short. And you also know that if you make 10 bets or 10 provisions or whatever, 10 forecasts, and you have 6 or maybe 7 right of the 10, you're absolutely fantastic, but you will not have 10 out of 10. Rarely, sometimes with sheer luck, but
Mhm.
not in the long run. And that's the thing. But the best traders, the Druckenmillers and so on of this world, sometimes they get it even right only 4 or 5 times out of 10. But if you then manage to make more money to the upside than you lose to the downside, and you can indeed let your profits run and cut your losses short, well, you can make a lot of money. So that's a little bit. If I've maybe one advice, something I've learned over the many years, that we should be humble, that we should know that we will make a lot of mistakes. If you get it right 6 or 7 out of 10 times, you're really, really good. But try to make the most of the upside and let the alligators not eat you alive in the 2 or 3 times you're wrong, because they will be
Mm.
there all the time.
It reminds me a lot of golf. I play golf, and some of my best rounds and a lot of people's rounds are when the mistakes they make don't penalize them as much. And that's what differentiates often like the really good players from average or bad players. The good players, they have good bad shots, which don't penalize them extremely by going into the water or out of bounds. It's just like something that allows them to keep going. And yeah, I see some analogies there. You've reached the end of this clip, but the story is not over. To watch the full episode, follow this link. Go on, you can do it.